Is the market going to crash like it did in the Great Depression of 1929? This is a question I see frequently, scrolling on Twitter or on platforms like Business Insider. Many of these posts suggest the market is dramatically overvalued compared to historical standards and due for a major crash, drawing comparisons to what happened in the Great Depression of 1929. It's easy to get caught up in these stories, which often fall under the category of FUD, or fear, uncertainty, and doubt. They're designed to grab your attention. They don't always provide that balanced historical perspective. I want to explore together how the financial system differs dramatically from 1929 and why those differences matter to investors. First, let's consider margin practices from then until now. Margin is when an investor borrows money from their investment company to invest in stocks. In 1929, investor speculation was rampant, and many investors were borrowing money to buy stocks, and they only had to put down 10% to buy $100 worth of stocks or more. This is an extreme level of leverage that created a fragile system where even small declines led to widespread margin calls, which is when investors are forced to sell in mass. That selling pressure quickly can spiral to a full-blown crash if large numbers of people are forced out of their positions. Now, today there's new regulations, and the amount that people can put down to borrow money for stocks is much higher. You have to put down usually 50% according to Reg T, and that significantly reduces the amount of systemic risk that isn't in the market. While speculative trading still exists, the system as a whole is much better equipped to handle market fluctuations without totally collapsing under the weight of this excessive leverage. Next, let's consider market depth and participation. In 1929, only about 10% of Americans owned stocks, meaning the market was shallow and limited to only the wealthiest people that had access to financial markets, dominated by a small number of participants. If fear took hold and a few investors rushed to sell, there weren't a lot of buyers there to stabilize prices. Today, more than half of all Americans own stocks, either directly or through 401k accounts. And this broader level of participation creates a deeper and more resilient market. With more buyers and sellers, there's a much greater likelihood that differing opinions, buyers, sellers, optimistic, pessimistic, people betting on one day, people betting on 1 year, all these people will come together in the market to absorb different interests and potentially create a much more stable open marketplace. Third, let's consider the development of FDIC insurance and the banking system stability that's developed since then. The Great Depression wasn't just a stock market crisis, it was a banking crisis. In 1929, if your bank failed, your savings were completely wiped out. Hundreds of banks collapsed, eroding the trust in the financial system and fueling a further downward spiral on other financial systems such as the stock market. In response to this crisis, the Federal Deposit Insurance Corporation was created in 1933 to protect depositors' funds. Today, if your bank fails, the FDIC insurance covers your deposit up to $250,000. This is a fundamental change and definitely protects our financial system and makes it a very different environment than what it was back in 1929 when widespread panic from banks easily bled over to the stock market, causing everyone to want to get their cash out. Lastly, let's talk about the automatic bid and the relentless bid of people buying into their 401ks. One of the biggest differences in today's modern economy is the way people invest. In 1929, stock purchases were mostly just one-off decisions made by individual investors. There was no steady flow of capital into the financial markets. Now, we have systems like 401ks where millions of workers are automatically enrolled and a portion of their paycheck is invested into the market every month, whether they realize it or not in a lot of cases. This is called the relentless bid, and it injects billions of dollars into the market on a regular basis, creating a baseline of demand for stocks. And even during downturns, it's very likely that a lot of these programs will still be buying and injecting capital into the system, which adds a layer of potential stability into the market that was never there historically. So what does this all mean? It's important to maintain a long-term perspective. This isn't to say that the market won't ever experience a correction or a major decline. History tells us that the ups and downs are inevitable. But the key is to approach these periods with an informed, long-term perspective. By understanding the differences between 1929 and today, we can get a better sense of what the financial system looks like and how we might be able to navigate market cycles, as opposed to falling victim to panic or fear that may be engendered by some of these articles that you find out there. If you find yourself worried about some of the dramatic headlines or social media chatter, remember that the financial system today is much more robust and more diversified and more regulated than it ever was a century ago. So it's important to stay informed and committed to a long-term plan. Hope you found this video helpful. If you did, please subscribe to our channel and visit us at www.parkmountfinancial.com.